After studying this module, you shall be able to learn the concept of foreign exchange risk and exposure, understand the relevance of exposure, know the nature and different types of exposure, show how the size of the different types of exposures can be assessed. In this module, we will consider the elements that comprise foreign exchange risk, exposure, and how they can be identified and quantified. Initially, the chapter begins with the concept of foreign exchange risk, which implies the exposure of a company to the potential impact of movements in foreign exchange rates. In the subsequent discussion, we shall discuss about the concept of exposure, its measurement and different types of exposures. At the end of this module, it has been shown that how the size of the different types of exposures can be assessed. Now let us learn the concept of foreign exchange risk and exposure. Firstly, let us look at foreign exchange risk. Every company that has exposure to foreign exchange risk must prudently manage and control its exposure together with management of other risks. Foreign exchange risk implies the exposure of a company to the potential impact of movements in foreign exchange rates. The risk that is caused by adverse fluctuations in exchange rates may result in a loss to the company. Foreign exchange risk arises mainly due to currency differences in a company's assets and liabilities and cash flow differences. Such risk continues till the foreign exchange position is settled. This risk arises because of foreign currency cash transactions, foreign exchange trading, investments denominated in foreign currencies and investments in foreign companies. The quantum of risk is derived out by multiplying the magnitude of exchange rate changes with the size and duration of the foreign currency exposure. Exposure. Michael Adler and Bernard Dumas define exposure as sensitivity of changes in the real domestic currency value of assets, liabilities or operating incomes due to unanticipated change in the exchange rate. Thus, as per the definition, it measures the extent to which the value of something in term of domestic currency is changed due to the unanticipated change in exchange rate. It takes into account inflation adjusted value. It also takes a change in both stock items such as balance sheet as well as flow item such as operating incomes. It exists on both domestic as well as foreign assets because unanticipated change in exchange rate can affect the value of both the domestic and foreign assets and liabilities, and it concerns only for unanticipated changes rather than anticipated changes, as such changes are already incorporated in the prices of assets and liabilities. Measurement of exposure. The value of foreign currencies, denominated assets and liabilities change their values because of fluctuations in foreign currencies. These changes are primarily unanticipated and it may cause by variations in short term interest rates, inflation, tax, equity market return expectations, etc. Change in the real domestic currency value of an item can be denoted as delta V, the spot exchange rate expressed as number of rupees per US dollar is equal to S. Unanticipated change, that is appreciation or depreciation of rupee in the value of the risk factor, is denoted as delta SU. Any appreciation or depreciation of rupee has its impact on the domestic currency value of the item, that is V. In other words, there is a functional relationship between delta V and delta SU. Let us estimate a regression equation considering change in domestic value of the item as dependent variable and change in the rupee dollar exchange rate as independent variable. The estimated equation may take this form: delta V is equal to beta 0 plus beta 1 into delta SU. Here beta 1 is the slope coefficient indicating the sensitivity of change in the value of V to change in S. The slope or coefficient measures the exposure with respect to the corresponding exchange rate. Generally, companies are exposed to three types of foreign exchange risk, that is translation exposure or the accounting exposure, transaction or the commitment exposure, and economic, that is operational, competitive or cash flow exposure. Here we briefly present each type of exposure and later we will discuss different techniques to manage these risks. Now let us try to understand the relevance or irrelevance of exposure. Firstly, the irrelevance of exposure. This argument is based upon the triple P theory, which explains that the movement in exchange rate is matched by the movement in price. Therefore, any talk about exchange rate exposure is irrelevant. Suppose a country is facing a high rate of inflation will lead to depreciation of currency in terms of other currency. This will lead to high import bill on account of depreciation of currency. The picture of high inflation is exactly matched by the high import bill. This in turn would lead to constant competitive position between the importing firm and the domestic firms even after the movement in exchange rate. Therefore, this argument goes against the relevance of foreign exchange exposure. Now, we can discuss about relevance of exposure. This argument is based on output of some good empirical research on the applicability of triple P in both short run and long run. As we know that triple B is not workable even in the long run. There are so many factors apart from the inflation rate differential that influence the exchange rate. On the ground of this argument, the change in exchange rates would not be matched by the same proportion change in inflation rate differential. Therefore, this argument goes in favor of the relevance of exposure in the international financial environment. Now, we can try to understand the nature and different types of exposure. First one is transaction exposure. Transaction exposure occurs when a company trades, borrows or lends in a foreign currency or sells fixed assets of its subsidiaries in a foreign country. All these operations involve time decay between the commitment of the transaction, that is sale of an asset for example, and the receipt or delivery of the payment. During this time interval, exchange rates will most probably change and the company is exposed to a risk that could be positive or negative. Imagine the case of a local Indian importer and a foreign, let us say US supplier. If the importer pays in the currency of the supplier, that is US dollar, then it is the importer who carries the risk or who has to buy dollars in order to pay the supplier. Alternatively, if the importer pays in its own currency, that is the Indian rupee, then the exporter is the one who carries the risk, or then it is up to him to change the Indian rupee into dollars. Usually, it is the exporter who is exposed to the exchange rate risk because usually he quotes the price in the buyer's currency. The second one is translation exposure. translation exposure arises from converting financial statements expressed in foreign currencies into the home currency. When a company consolidates the results of all its foreign subsidiaries, it has to present a final report to the shareholders, and the numbers in this document should be expressed in one currency. All foreign currency denominated assets and liabilities as well as revenues and costs have to be translated in one base currency. Assets, liabilities and equity on a balance sheet are expressed in historical values, and the foreign exchange rate at which the currencies trade at the end of the accounting period is most probably not the same foreign exchange rate when the accounts were booked. For example, a US parent company has a wholly owned subsidiary in Australia. This subsidiary has exposed assets of Australian dollar equivalent to 100 million and exposed liabilities of 50 million Australian dollar. The exchange rate declines from 4 per US dollar to 5 per US dollar in terms of Australian dollar. The potential foreign exchange loss on the company's exposed net assets of 50 million Australian dollar would be 2.5 million US dollar. In this case, the net exposure is 100 million Australian dollar minus 50 million Australian dollar is equal to 50 million Australian dollar. Pre-devaluation rate is 4 Australian dollar minus 1 US dollar is equal to 50 million Australian dollar or 12.5 million US dollar. Post devaluation rate is equal to 5 Australian dollar, which is equal to 1 US dollar, and 50 million Australian dollar or 10 million US dollar. Potential exchange loss in millions is 2.5 US dollar. Economic exposure. Economic exposure measures the change in the present value of the firm resulting from any change in the future cash flows of the firm caused by an unexpected change in the exchange rates. Future cash flows can be divided into cash flows resulting from contractual commitments and cash flows from anticipated future transactions. In a way, economic exposure includes transaction exposure in itself. Transaction exposure is the part of economic exposure comprising future cash flows resulting from contractual commitments and denominated in foreign currency. However, we should make a clear distinction between transaction exposure and economic exposure. Transaction exposure arises from firm contractual commitments and the amounts to be paid or received are known. With economic exposure, these amounts are uncertain and based on estimates. Economic exposure can be defined as the future effect of foreign exchange changes on liquidity, operations, financial structure and profit. Economic risk arises, for example, when a multinational firm incurs cost in one currency and generates sales in another. In this case, changes in foreign exchange rates affect the competitive position of the firm. Profits may decrease if the cost currency appreciates against the sales currency, or it becomes more expensive to buy materials and cheaper to sell finished good, for example. This will inevitably change the expected future cash flows and thus the value of the firm, which is present value of these cash flows. Price changes are another component of a firm's economic exposure because they affect future cash flows. Economic exposure can arise because the competitive position of a company could be affected by a given exchange rate volatility. Different factors can affect the future cash flows of a company, and hence its economic exposure. The investment policy of the company or external factors such as political crisis in a country that would affect the level of sales, for example. It is difficult to identify and quantify this kind of risk as it may involve movements in currencies in which the company has no physical dealings. From a theoretical point of view, economic exposure should be the relevant exposure concept. However, it is more complex to cover economic exposure than the transaction exposure. Now, there are certain transaction, translation and economic exposure which can be compared with each other. Transaction exposures and translation exposures are interrelated. A company will not be able to do away with both these exposure. If it minimizes transaction exposure, then it incurs translation exposure or vice versa. For example, a parent may ask a subsidiary to bill all its payments to and receipts from the parent in parent's reporting currency. This mitigates the transaction exposure to the parent as the parent's all receipt and payments are in its reporting currency. But this increases the subsidiary's transaction exposure as the reporting currency of the subsidiary is different than the parent's reporting currency. By doing this, the parent may reduce its own translation exposure, but all its subsidiaries would incur transaction exposure. The major differences between operation or economic exposure and translation exposures are: translation exposure arises only when a firm has a foreign subsidiary or foreign operation, but economic exposure arises even when a company is purely a domestic company. Economic exposure measures the impact of exchange rate on all future cash flow, while the translation exposure arises only when consolidated account settlements are prepared. Hence, economic exposure is a forward-looking concept, while the translation exposure is a backward-looking. That is, past performance of the subsidiary is translated as per the parent's reporting currency. Economic exposure affects actual cash flow of the company, while translation exposure results in translation gain or loss, mere accounting entry. Now, let us have a look at the measurement of different types of exposure. Number 1, measurement of translation exposure. The current and non-current method. This approach uses the traditional accounting distinction between current and long-term items and translates the former at the closing rate and the latter at the historical rate. Accounting exposure for a foreign subsidiary at a particular point in time is given by the net figure of assets less liabilities that are exposed to potential change should exchange rates alter. Evidently, according to the current or non-current method, the sum exposed is net current assets. One of the implications of this method of translation is that inventory is exposed to foreign exchange risk, but long-term debt is not. The logic of such an assumption is by no means apparent. Indeed, it should be clear that long-term debt is very much exposed to exchange risk. In home currency terms, the cash amount of a foreign currency denominated loan, whether a payable or receivable loan, will change as exchange rates change. This lack of logic underpins the move away from the current non-current method, which has been discussed over recent years. Then the all current or the closing method. This method merely translates all foreign currency denominated items at the closing rate of exchange. Accounting exposure is given simply by net assets or shareholders' funds, sometimes called equity. This method has become increasingly popular over time and is now the major worldwide method of translating foreign subsidiaries' balance sheets. The monetary or non-monetary method. Monetary items are assets, liabilities or capital, the amounts of which are fixed by a contract in terms of the number of currency units regardless of changes in the value of money. Translation via the monetary and non-monetary method involves monetary assets and monetary liabilities being translated at the closing rate, while the non-monetary items are translated at their historical rate. Accounting exposure under this method is given by net monetary assets. In terms of development of accounting reporting, this method of translating foreign subsidiaries accounts seems to be halfway house between the current and non-current method and all current method. The temporal method. The temporal method of translation uses the closing rate method for all items stated at replacement cost, realizable value, market value or expected future value, and uses the historical rate for all items stated at historic cost. The rationale for the temporal approach is that the translation rate used should preserve the accounting principles used to value assets and liabilities in the original financial statements. According to the temporal method, the translation rate for each asset or liability depends upon the measurement basis used in the foreign subsidiary's original account. Then there is measurement of transaction exposure. Transaction exposure arises because the cost or proceeds in home currency of settlement of a future payment or receipt denominated in a currency other than the home currency may vary because of changes in exchange rate. Clearly, transaction exposure is a cash flow exposure. It may be associated with trading flows such as foreign currency denominated trade debtors and trade creditors, dividend flows or capital flows such as foreign currency denominated dividends or loan payments. Measurement of economic exposure. The measurement of economic exposure is difficult because it is almost impossible to measure the effects of exchange rate movement on cash inflows without simultaneously considering the impact on cash flows of the underlying relative rates of inflation associated with each currency. Therefore, it is not possible to hedge economic exposure because one cannot know a priori what would be the effect of exchange rate movement on future cash flows and hence future profitability. Now let us sum up this module. To sum up, we can say that the foreign exchange risk implies the exposure of a company to the potential impact of movements in foreign exchange rates. Foreign exchange risk arises mainly due to currency differences in a company's assets and liabilities and cash flow differences. Exposure has been defined as the sensitivity of changes in the real domestic currency value of assets, liabilities or operating incomes due to unanticipated change in exchange rates. Actual exposure exists when a currency receipt or payment that will definitely take place because it results from a firm order or sale for which an invoice or other documentation has been issued. Exposure has been measured as a slope of regression line which is sensitive due to unanticipated changes in exchange rates. The transaction exposure, the risk that the base currency value of a foreign currency denominated trading transactions will vary as a result of changes in exchange rates, giving rise to an increase or decrease in reported profit. The translation exposure, in which the risk that when translated at the foreign exchange rates which will apply at a future balance sheet date, the domestic or base currency values of assets and liabilities on the balance sheet will alter, resulting in a reported gain or loss. The economic exposure, which measures the change in the present value of the firm resulting from any change in the future cash flows of the firm caused by an unexpected change in the exchange rates. Economic risk arises when a multinational firm incurs cost in one currency and generates sales in another currency. In current and non-current method, all current assets and liabilities are translated into domestic currency at current exchange rate. In case of current rate method, all balance sheet and income statement items are translated at current exchange rate except equity. In case of monetary and non-monetary, all monetary items are translated at current exchange rate, while non-monetary items are translated at historical exchange rate. In case of temporal method, there is only one modification over monetary and non-monetary on the treatment. Inventory is translated at current exchange rate. Transaction exposure arises because the cost or proceeds in home currency of settlement of a future payment or receipt denominated in a currency other than the home currency may vary because of changes in exchange rates. The measurement of economic exposure is difficult because it is almost impossible to measure the effects of exchange rate movement on cash flows without simultaneously considering the impact on cash flows of the underlying relative rates of inflation associated with each currency.